The housing market is one of the largest contributors to wealth in people's lives. The average net worth of a homeowner, after all, is nearly 20 times that of a tenant. And a fall in home prices are expected to destroy already low consumer confidence and lead to less spending, potentially pushing us into a recession. We already know that for every $100,000 in net worth someone loses, they tend to spend $2,000 to $3,000 less per year. A statistic that is very concerning, given that together in the United States, we have amassed a $43.4 trillion housing market. And folks, let this be a warning to you. The housing market disaster just got worse. Now sure, you might be thinking, come on, home prices are at record highs. Like, what do you mean things have gotten worse? It sounds pretty good. Well, that's what you're gonna learn in this video. First, you're going to see why the Fed is fueling the fire to destroy housing and actually increase inflation before they decrease it, which is a substantial irony. Then, you'll see the cracks forming in the housing market. I'll give you evidence with what home builders are telling you right now. And you'll learn what to watch for, so that way you can be in a position to profit. First, let's talk about and learn about inertial inflation and its impact on the Federal Reserve, and how it ironically can increase inflation before it can lead inflation to go down, and how it crushes the housing market. The Federal Reserve has already raised rates to 1.5% at the Fed funds rate, and we're now expecting the Fed to raise rates all the way up to 3.5% to 4.25% potentially, all in an effort to stamp out inflation. Their now mostly single mandate goal: end inflation at all costs, even if that means the destruction of wealth of Americans and potentially even twice the joblessness rate we have today. But folks, there's a fundamental flaw in the way that inflation is calculated. 33% of inflation is weighted on what's known as owner's equivalent rents to try to get an understanding as to what people's housing expenses and how their housing expenses are changing over time. However, this reported rent does not accurately reflect what market rents are. In fact, there's a very clear lag between market rents increasing and owner's equivalent rents increasing. Most research, including the projection chart on screen from JP Morgan, suggests that owner's equivalent rents lag by about 6 months. And this creates really massive issues. In a Board of Governors discussion paper by the Federal Reserve titled Monetary Policy, Housing Rents, and Inflation Dynamics, we learned of something very ugly. That when the Fed tries to get inflation under control by raising rates, they have the effect of increasing mortgage rates. That can drive more people to rent properties, driving up the cost of rent while reducing the availability of homes for rent, again contributing to an increase in the cost of rent. Then, 6 months later, higher rents show up in CPI inflation, and this is the substantial irony, that the more the Fed raises rates, the more people are driven to renting and not buying, because buying becomes substantially unaffordable. And now the Fed is actually driving up something that has a 1/3 weight in inflation. So even if airfares were to come down, or even if apparel or used car prices came down, leading inflation to come down, they might be immediately offset by increases in the owner's equivalent rents, which is sort of a misleading way of measuring housing and rent inflation anyway. But this is ironic. Again, when the Federal Reserve, and we know this, when the Federal Reserve raises rates, buyers lose purchasing power to the tune of about 10% per 1% increase in mortgage rates. So if mortgage rates go up 3%, buyers lose about 30% in purchasing power. But if at the same time the Federal Reserve is actually driving up one of the heaviest weights in the inflation basket, then the Fed is actually creating more pain in the short term by raising rates, driving up the costs of rent, also driving up the costs of producing goods, again via increased wholesale prices, credit lines, you name it. And so what ends up happening? Before things get better, things get worse. And that could lead the Federal Reserve to raise mortgage rates even more than they actually need to, leading the housing market to experience even more pain. And folks, the cracks are everywhere. Yesterday, Lennar reported earnings. They are the second largest home builder in the United States that's been building homes for almost 70 years. Take a look at some of the sections from the Lennar earnings call. Some would call it a disaster. And what you're about to see is a warning that should make you really interested in preparing yourself, in getting ready for what's to come. But see, we don't get taught about real estate in schools or by most of our parents. I feel blessed to be part of a real estate family who's been buying below market wedge deals and property managing professionally for 40 years. And as a real estate broker for over 10 years, a former licensed lender and licensed contractor, someone who went from zero to millionaire in real estate by 23 years old with nothing at 18 to over $20 million of real estate by 29, I've put together an amazing program for you on building your wealth with real estate. It's linked down below. It's the Zero to Millionaire Real Estate Program. A lot of people bundle this up with the programs on stocks or real estate agent programs or the property management programs, but Zero to Millionaire is the place to start. You can get 50% off with the expiring coupon code linked down below, and this will teach you the path to not only save money with our partnership with Lowe's or to save money by making the right decisions, but it'll also help you go from zero to millionaire, help you identify and understand the real estate cycle, identify good deals, identify good multifamily, single family deals, international deals. 90% of the course is applicable to international communities because real estate is principles based. You just adjust a little bit for taxes and loans. But we also teach you how to save money, investing for the long term, making the right decisions in renovations. And we'll teach you how to work with the right individuals because real estate is a people business. So if you want to become a people business expert and you want to make money investing in real estate during this next downturn, this is the program for you. It's not a flippers course. It's a program on building your long-term wealth. And let me tell you, the cracks are here, folks. The cracks are here. And this is why this is the most opportune time to get educated in real estate. Take a look at this report from Lennar. This report from Lennar is out from June 21st, 2022. It's a very recent look into the housing market and what's happening. Take a listen to what Lennar, the second largest home builder in the United States, is telling you. Quote, so far in June, new orders, traffic, sales incentives, and cancellations have worsened in many of our markets due to the rapid spike in mortgage rates and headwinds from negative economic headlines. And the pain falls under three categories. Category 1, minimal impacts. Category 2, modest impacts. And Category 3, significant impacts. Take a look at Category 1. Florida, Jersey, Maryland, Charlotte, Indianapolis, Chicago, Dallas, Houston, San Antonio, Phoenix, San Diego, Orange County, and the Inland Empire. All of these markets have benefited from extremely low inventory, and many of them are benefiting from a strong local economy, employment growth, and then migration. And while these markets continue to be strong, here's your crack. Our sales pace and purchasing power has started to flatten or has flattened in each of these markets. So even though these are hot markets with low inventory, purchasing power has flattened or is flattening. These are the good markets. Category 2 markets. This is where things start getting worse. Atlanta, Colorado, Charleston, Myrtle Beach, Nashville, Philadelphia, Virginia, the Bay Area, Reno, and Salt Lake City. In each of these markets, traffic is slow, and we've seen an uptick in cancellation rates, and they're now having to offer more aggressive financing. Now, one of the most important things to know about a home builder is that home builders don't like lowering prices. So when they lower prices, you know things are bad. They would rather give you what are called builder incentives, such as buying down your mortgage with aggressive financing programs, or by giving you more incentives to spend money on improvements for your property. And so when they're talking about targeted price reductions, selectively reducing our sales prices to solve for a mortgage payment that works for the buyers, and now they're trying to sell you on a payment, you know we have issues. Category 3 market. More significant market softening and correction, including areas like Raleigh, Minnesota, Austin, Texas, Los Angeles, Central Valley, Sacramento, and Seattle. Raleigh was an extremely strong market, but softened significantly at the beginning of June. These cracks are just now starting. People keep talking about how great the housing market is, how great it's been so far, even this year. Oh, it's holding up great. The cracks are just now beginning. Take a look at this. As a result, We have room for needed future pricing adjustments because prices have gone up. But look at the Minnesota market. It's been very challenging. Buyers have always been conservative in this market and rates have increased. But there's now been a strong pushback against the current pricing. This is a problem. And they now see strong price reductions. Austin, Texas. Higher rates in June and headlines on the stock market declines have distressed the national economy, sidelining many buyers who were waiting for a reset in home values. And while inventory is limited, right? The biggest argument that everybody keeps saying, oh, real estate can't go down because inventory is limited. Oh yeah? Well, what's happening in Austin? Cancellation rates have increased and we've reduced home prices in many communities on a home-by-home basis and have offered extremely competitive mortgage programs. These pricing adjustments are starting to generate increased sales activity, but again, they're having to drop prices. Take a look at this. Los Angeles, Central Valley, and Sacramento, extremely credit-challenged buyers with cancellation rates increasing. And what do we have in the Q&A? Well, one of the executives at Lennar telling you, at the end of the day, we're probably going to push more people from home ownership towards renting. That means multifamily, traditional multifamily, as well as single-family homes for rent. And again, exactly why you want to become an expert real estate investor, because the opportunities for rents going up and prices going down are an opportunity to make money and to build your wealth, your long-term wealth. But wait a minute, is this just happening in the United States? No, of course not. Take a look at the index for frothy markets throughout the world. The United States ranks 7th with a price-to-rent ratio of 139 and a price-to-income ratio of 135. New Zealand tops the list, followed by the Czech Republic, Australia, Canada, Portugal. Folks, this is a global issue. And why this is happening should be obvious. More than 60 central banks around the world have raised rates this year, and they're not on pace to slow down their rate hikes anytime soon. Even Jerome Powell, the chairperson of the Federal Reserve, said today that home prices are, quote, unsustainably high in front of Congress and sees no chance that home price appreciation doesn't slow, if not potentially lead to a fall in home prices. He went as far as saying this to first-time home buyers just last week.
I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels.
Redfin just reported that at the end of the year, 61.6% of people could afford a home on a $2,500 per month budget. Today, only 45.6% of homes are affordable with this budget throughout the entire United States. And in Phoenix, only 21.5% of homes are affordable. Of course, the same argument that is made that, oh, housing can't fall, it won't fall, it'll continue to rise, is one that increasingly seems unlikely. Those who suggest that, well, but Kevin, there are more households or more people in buying age or in the buying age today than there were in the mid-2000s, conveniently forget that homes are now 60% more expensive than the mid-2000s, and in many cases double to triple what we had seen previously. But also that home prices have substantially outpaced increases in incomes, with home prices on average 20% more than incomes have risen. Supply chains have also created another potential disaster for home builders. Take the Dallas, Texas market, for example. There are now twice as many homes in construction in the Dallas market than at any point in the past. This is partially due to massive supply chain-led delays that have stalled the building process as home builders waited for garage doors or even appliances like refrigerators and dishwashers or windows or doors, you name it. That temporarily depressed housing inventory towards the end of 2021 and beginning of 2022. But as that inventory comes online towards the end of 2022, at the same time as interest rates are now 4 percentage points higher than where they were in the past, that is the recent past, just December, we could expect a disaster of a flood of inventory just at the wrong time when rates are high. So what's likely to happen? Well, first, multiple offers go away. Redfin has already reported that the share of multiple offers per home is going down. Second, we start seeing price drops on active listings. Nationwide, we've seen a substantial impact in the number of homes with price drops. You can take a look at this yourself by just looking at the Redfin data center. Look at the Redfin data center of percent of active listings with price drops in the entire United States averaged together on a rolling 4-week average. This means it's even worse probably now. And this data right here, as of about 10 days ago, it updates about every 2 weeks. But take a look at this. This black line here is 2022. And we are seeing substantial price drops, more than we have ever before in the last 4 years. This is how it begins, folks. Price drops. What happens after price drops? More stagnant listings. This is a sudden and stark transition. And after these price drops, come, of course, inventory stagnating and building up. That is, less homes selling every single month despite price drops, more homes sitting on the market. Then we'll actually eventually start to see home prices fall. And see, the thing about real estate is real estate moves very slowly. Homes are appraised based on previous month's sales, so it could take 3 to 6 months, sometimes even longer, to actually see home prices be affected. That's because people buying in March look at what people paid for their homes in January and think maybe they're getting a good deal in March because they're paying the same price and prices haven't gone up. But oh, wait a minute, the person buying in January had a 2.5% mortgage. The person buying in March had a 4.5% mortgage. The person buying in June had a 6.5% mortgage. Prices will come down. Even agents can feel it happening immediately with more buyer anxiety, cancellations, and lower offers. And we're seeing it in the data as well. Once prices start to drop, there's then the fear that mainstream media will over-dramatize the drop and potentially lead to more selling or panic selling. Now, some say, but who would move? Because if you sell, you're just going to have to rebuy again at a higher interest rate. It's the most common question I get asked. But folks who ask this question don't understand how real estate works. There are plenty of people who sell homes every single day and don't buy another home. In fact, as a real estate agent, maybe 1 in 10 of my home sales was somebody who was selling to buy another home. That's because some people retire. They move into an existing property that they own, an existing rental property, they move in with family. Or maybe they're a second home seller raising money to buy other assets or sit in cash. Or they're investors who straight up don't have to rebuy because they're a mom and pop landlord or they're a hedge fund. These are companies or people who do not have to rebuy when they sell. Some people also just decide, I'm going to sell on purpose and go rent, and they contribute to rent prices going up. So what should you do? Well, first, get educated. As prices fall, you need to educate yourself. Prepare for the opportunity of a lifetime to buy real estate at depressed values. Learn how to identify deals and work with people. Real estate is a people business. And if you're not aware of the tricks of real estate, you can learn everything linked down below with the 50% off coupon code expiring in a few days before prices rise again. And you can join me in private live streams where we talk not only about the market, but about what I'm doing in real estate, and we analyze deals together. Second, should you short home builders or the real estate sector? Possibly. According to Bloomberg, the MSCI World Index, the real estate sector of the S&P 500 or the MSCI World Real Estate Index still sits above its 10-year average. That means real estate prices in the stock market still actually have a substantial amount of froth left in them, even though many home builder stocks, for example, have already fallen 25 to 40%. There is more room to fall. Third, you should raise money and pay off your debt. Now is the time to work harder and smarter to get out of debt. Don't buy or lease a new car, don't finance anything, and start paying down debt to prepare to buy real estate. Fourth, stay away from syndications. They are the most expensive form of buying real estate, often with promoters who charge insane fees like 2% management fees every single year and 35% waterfalls. It's insane. Fifth, share this video. Tell your friends and families about what's happening. You're owed the truth. And a falling housing market could mean more joblessness and the wealth effect of falling home values crimping our economy into a recession. So be prepared and get ready. Now is the time to be a survivor.